Hey traders, Raghee here. Welcome to Charts and Coffee. Great to have everyone here. Happy Wednesday. Hope everyone's doing well. We have a busy economic calendar. I think it might be wise to start there in terms of what we're going to be dealing with for the morning. And here we go. So take a look at, this is Forex Factory, and take a look at the calendar. What we have is a number of FOMC speakers really sprinkled throughout the week. Luckily, Powell was first and not, later in the week. So we had a pretty good idea of what to expect. Chances are the only reason Williams or Barr or Waller or whomever else might sound a little different than Powell is if that they've agreed that the overall marketplace has not interpreted their messaging, meaning Powell's messaging, correctly. So maybe some course corrections. If not, they're just going to echo his sentiment usually. Let's talk about what the sentiment is. And this is really easy to measure. I know a lot of you are becoming really big fans of the Fed Watch tool. This is the easiest and really the only necessary macro when it comes to what is the Federal Reserve going to do and what does it mean to us and when are they going to do it and what are they going to do? All right. We're going to get to 4 3/4 to 5% in terms of that terminal target rate. Well, no, not the terminal rate. That's the peak. It looks like increasingly 5 to 5 1/4 is where we're going to land. So we get a 1/4 point hike in March. Remember, we already had that quarter in February, quarter in March, quarter in May. Now here's the drum roll. Are we going to get another quarter in June? And that is where the uncertainty lies. That's where when that 5 to 5 1/4 gives way to 5 1/4 to 5 1/2, which is yet another 1/4 point hike. That's the adjustment that now needs to be made, obviously going from data point to data point, whether that be growth, inflation, jobs. That's going to be how those columns align for June. There was some expectation that we could peak in March or May at that 5 to 5 1/4 or 4 3/4 to 5%. Now we're pushing the rate hikes potentially later into the year, June, and now we're between these two. Neither one of these outcomes, gang, is going to be a stock market killer or a bond killer or send the dollar to brand new highs. It is going to keep yields slightly stronger. It's going to keep the dollar slightly stronger until we've adjusted for this reality. And then it goes back to the trend it was. So my approach to this is remain bullish equities, remain bullish bonds, and remain bearish the dollar or bullish euro. So if you kind of want a trio of bullish places to look, equities, bonds, euro as an inverse play on the bearishness in the US dollar. All right. So with that being said, all right, let's go ahead and jump into, I did mention the FOMC. Check out forexfactory.com. Check out Trading Economics, and you'll see that it's not going to be smooth sailing. The bell rings, and we're already 15 minutes past the Williams speaking engagement, which is going to happen in about 10 minutes, 11 minutes here. 10 o'clock bar. Not as impactful as Williams in terms of a Fed member who can move the market, but if they have FOMC in front of their name, clearly they can. 145 Waller, which should make for an interesting close. In between all that, we do have crude oil inventories and the 10-year, which means ZN, the futures contract, or the ETF IEF will be in play. All right, so let's get to it. What do we have coming up in terms of structure and decisions to be made? And what is it that we're looking at? A little bit of wait and see after the rally yesterday. Really nice rally, bounce right off the DPMRs, kind of holding for now, but we'll see what we get. So yeah, hey there, JR. We're looking at, 10 a.m., but we're getting at that 9:15 first, right? So we get Williams at 15 minutes before the bell. Then we get, Barr 30 minutes after. So yeah, the hits just keep on coming. I agree. All right, Kevin, happy hump day. Yep. Could I please evaluate? Sure. URA, uranium, and steel. Sure, for long calls. Let's jump on over then to the tops layout so we can take a look at the wave and market structure here and the daily. So let's move the daily, get a little bit bigger here. As we look at the daily, the chart to the right, north of the 200, sinking into the wave. I do like that for long calls. That's a reversion to the mean. What do I need for that? Uptrend, pull back into the wave. So I do like that. Kevin, I agree. And X, look at the size of the candle on X. That's a larger than normal candle. For you Princess Bride fans out there, it is a candle of unusual size, meaning we want that pause pattern. A pause pattern is a price pattern, not a chart pattern. I don't use chart patterns, price pattern, right? So we're looking at a minor low or an inside candle. Let's let price prove that we're pausing after that reversion to the mean. So like them both, I would be a little bit more cautious post earnings and post that large candle in X. And then also, I'll tell you what, Kevin, another thing that I would do. So if we were in the mastery right now, as soon as you bring up X, what I would do is immediately pull up XME or SLX. So let's do this together here so y'all get a taste of the process that we use in the mastery. And the process is really hinging on two really strong beliefs, they're facts, quite frankly, which are the overall indices, the sectors, they're all high concentration weighted. The really important ones, the majority of them, have very few stocks that have an overwhelming, disproportionate impact on where that index or sector goes. Think Apple and Microsoft and XLK. Think the way in which financials and healthcare are quite heavily weighted within the Dow, right? We have a small number of sectors and or stocks that are having a disproportionate influence on the broader averages. It's not an even weighting, right? I think a lot of you know this, but because of that, that helps us. That's actually really great. So what I'm able to do is look at something like X and realize that it's hanging out with a number of other stocks in, say, SLX, which is a steel ETF. Now, when we do scans, right, the process of sector secrets is what? Scan with a commonality, not a technical commonality. Scan with a weighting commonality. And that's the other thing I would recommend you do, Kevin. Jump in and ask yourself, is X the best place to be? Or could I find some clarity elsewhere within a group that obviously you've singled out with X, but could possibly be a little bit more beneficial to your overall watch list? Remember, our watch list dictates in a large degree our trading success. Spend some time on that watch list, dial that in, and then I love how you're playing that directionally, Kevin. Love it. All right, Stacy, remember to hit the like before you leave. Absolutely. I appreciate that, Stacy, my fan club president. All right, moving on to Prince. Can I explain what swing high low, what a swing high low is? A swing high and low, and is it usually a default first target for a wave entry? So swing highs and lows, it does have sort of a randomness to it, right? What does that actually mean? It probably depends on who you ask, right? So first of all, let's define what a swing is. The probably the common way to look at a swing is it's sort of it's a shift, right? So one way to look at a swing is a shift, right? Where did price action shift? All right. How do we define then the shift? And in the definition of that, right? Now remember, don't just say, okay, I'm looking for a swing. Know what the definition is. For me, I'm going to define a swing most often as a minor high price pattern or a minor low price pattern. We've automated that with the Darvis 3.0. There's actually the signal that I talk about in Darvis 3.0 is actually that pattern, that price pattern. That's what I look at as a swing high low. It has to accompany that pattern. Otherwise, what's the process? right? One of the cool things about creating an indicator is taking something that we might have been doing in a more subjective way based on experience or whatever, and then make it mechanized. That forces us as traders or indicator builders to say, well, I need to find the pieces, those tiny pieces that make whatever true, right? So for me, what makes a shift, what makes it true, the definition is that pattern, the minor high or the minor low pattern. And is there an indicator for it? Yeah, the best one's going to be the Darvish 3.0, where we not only automate the support and resistance on the chart. Nothing really does it better than that. 70 years time tested. And then adding to it what I like, which is the minor highs and the minor lows. All right, next up. Thank you for the question, Prince. And as far as the default target for a wave entry, I do like that. Yes, I do like that. That is very often what we're going to use. It's not the only thing I'll consider, but it's probably my first go-to. Yeah. All right. Hawk asks, what would a setup in Starbucks look like? Well, I would go through that process, Battlehawk, that I walked Kevin through. And then if Starbucks meets that criteria, I would look for a trend following entry to the long side. All right, next up, could I analyze the XLE on the 30-minute? Hey there, Eva. Okay, cool question. We analyze the XLE on the 30-minute. Sure. Let's do that. I'm looking at the tops layout with the daily price movement ranges on here. This is a 1-hour chart, which is my preference for identifying opportunities for short-term swing trading. What does that mean? Overnight, less than a week, right? It could be 1 or 2 days. It could be that very day, but it is generally going to be less than a trading week, less than 5 days. So less than 5 days. All right. With that said, let's shift that to the 30. Now, the 30-minute is still going to benefit from the daily price movement range for sure. And so we'll leave those on there. That's the daily range volatility, historical volatility, and XLE on a 30. We always start with structure. Eva, if for those of you that are in the mastery, we always start with structure. We always start at the bottom of the chart. Think of it this way. We always got to start at the floor. We always got to start at the foundation, right? And we build everything upon that. It's no coincidence at the very bottom of my screen, the foundation is the market structure. All right. Okay. We go up from there. This is generally bullish. So I would look to buy the dip, mean reversion, 200 propulsion. Yeah, that would be absolutely the way I would go. But let me walk you through the first trade that preceded it. So I'm not picking one out. This is the trade that preceded the next one that could come up. Take a look right there. So the one that preceded it was a choppy market environment, sunk into the DPMR for the better part of 1, 2, 3, 4, 5, about 6 hours, maybe almost 7, sunk into the support of the daily price movement range, which, by the way, is automated. It's automated and sitting on your screen. So when price gets down there, you can set an alert to go off and say, hey, I think I want to buy this thing, or maybe I'm going to buy calls on the XLE. And that was the trade that preceded it. Okay, that was the trade that preceded it. So the next one I'm going to be looking for is a reversion to the mean. My definition of the mean, which it's going to vary from trader to trader. There is no one mean, which all that means is average, right? It's the 34 EMA wave. Thanks for the question, Eva. Good stuff. I like when you all ask me about time frames that I don't necessarily trade, because I really love showing you all that while we can pick our favorite time frame, the one that serves our needs for whether our limitations to access the market or our desire to be more active in the market, a sound set of indicators and a time-tested strategy will work on any time frame, which is to say it needs to be universal, work on everything, and it needs to be robust, work well, right? And that's the way we always want to think about it. So thanks for the question. Hey there, Stephen. Thoughts on long AGI? Yeah, I'm fine with that. It's an oversold, potential oversold buy. NEM, that would be, I would pass on that. compared to, so if I'm going to rank this, Stephen, AGI looks good, NEM looks less good. So let's rank these, right? Let's do some good watch list building. BKR. BKR is your best trend. AGI is your next best trend. NEM doesn't have a trend at all. But if we're looking at an oversold market that's moved into a neutral environment, good price pattern, I would rank these as prefer the trend, then the market that was in a trend and is consolidating. Last, I would put NEM as far as my preference. Hey there, Martha. After a hot zone like yesterday at 1250, yeah, the 1240, 1250, that I thought it was 1240. But anyways, the Powell Shore event, how long do I wait to trust my hourly price movement ranges again? A great question, Martha, but let's go upstream a little bit to that. And let's go to the 1 hour and the 30-minute on, say, the S&P, right? That's a great bucket, kind of catch-all for lots of movement. What do I want to do here? Well, first of all, if it's a Powell event, do I really want to day trade this thing on, say, a 5-minute time frame or even a 2-minute time frame? Or would I rather give respect to the volatility and say, look, will HPMRs be able to handle whatever is going to come out of Powell's mouth? Or do I need a little bit more travel on the suspension, since we are most certainly going off-road most of the time, anytime Powell opens his mouth? So what I'm saying is we can look at hourly historical volatility, or we can look at daily historical volatility. I'm going to opt for the daily historical volatility, and I'm going to show you exactly what we had. There it is. Right. So if you're looking at something that can manage some rougher off-road terrain, it's usually going to be the DPMR. I love my HPMR, but when we're seeing higher volatility, we want to ask ourselves, is a 5-minute and an hourly volatility range enough to contain, to manage certain events like Powell? And I would say that's where the DPMR, as you can see right there, is going to shine. All right, so let's see here. Sergio asks, does the 10x indicator measure the same that the multi-trend does? Sergio, I don't know much about the 10x. I know that's John's color-coded candle process. I don't believe that they do measure the same thing at all. They are looking for similar things, but they're going about it differently. The multi-trend and the grab are built upon moving averages. The 10x, I don't believe is. I think it's more of a combination of ADX and something else. Oh, DMI. So no, they're not looking at data in the same way. And not to say one is good or one are bad. It's just there's chocolate ice cream and there's vanilla ice cream. And so yes, they're completely different. They're completely different in that. They're trying to do a similar thing, I believe, but no, they do not measure the same way. No, not at all, really. Okay, next up, let's see. Okay, I appreciate the feedback. Panabiker, I appreciate that. English is my primary language, so I will pass that on to the office. I appreciate it. All right, next up, what are my thoughts on ES price delivery being algorithmic in nature? It seems it moves to attack previous swing highs or lows for liquidity. Glenn, I will summarize my feeling on that with something that one of my mentors told me. He was both a floor trader. He made the rather rare transition to being a back office trader, which is to say off the floor, and then he manages a ridiculous amount of money. So I'm going to go to someone who is influential on me and frankly better at this game than I ever was. And it's my mentor. He has passed, but he taught me this, and I do believe it's true. The market moves in the direction of the most stops. And anything that complicates that truth is frankly unnecessary for me. The market moves in the direction of the most stops. And I think, Glenn, that's probably the best way to answer your question. All right. I appreciate the questions, gang. As always, thank you for joining us for Charts and Coffee. Thank you for caffeinating, dominating. Thanks for being inquisitive. Thanks for wanting to be better traders. I absolutely love the enthusiasm, and I'm excited for your journey, wherever you are on your trading journey. We try to meet traders wherever they are on their journey in the Sector Secrets room, whether they're noobs and we've all been noobs once, me too. Some days I feel like I'm there again, whether they're brand new, whether they're in a process of learning more, or whether they're in a process of of fixing past mistakes. Automating indicators is the way we can fix these things. And that's what I seek to do. All right, gang, as always, be good to each other. I'll see you tomorrow. Same time, same station.